As a business owner, one of the most frustrating parts of owning a business is at certain times running a little thin on the margins. The one thing you definitely never want to feel is like you may be short for payroll. If that's occurring at this time, I may have a solution for you. Like most small business owners, this past year, we've met with a lot of challenges. We've innovated, and that has cost us, so margins can be thin. Our employees are our bread and butter, and so we want to handle that as quickly as possible. A product that has instant approvals that can possibly give same day or next day funding is exactly what we need. To fix this situation once and for all, you may want to then, after a bridge loan, go to a term loan, which is even higher amounts that you may be approved for. So why not find out what you're approved for now and think about it. Maybe you found a funding source that can not just help you with this week's payroll, but that can also help you fix a lot of your other financial issues, and possibly you found a resource for expansion into the future. Thank you.
When it comes to securing financing for your business, there are various options to consider, with business lines of credit and loans being two of the most common choices. But how do you decide which one is right for your specific needs? Let's explore the key differences between business lines of credit and loans to help you make an informed decision. Understanding business line of credit versus loan. Before we explore the pros and cons of each financing option, let's clarify the fundamental differences. Business loan. A lump sum of money borrowed for a specific purpose with set repayment terms and interest rates. Business loans are typically used for large, one-time expenses. Business line of credit. A revolving credit facility that provides access to a predetermined amount of money. You can draw from this line of credit as needed, pay interest only on the amount used, and reuse the credit as you repay it. Business lines of credit offer flexibility for ongoing or unexpected expenses. The flexibility factor. If flexibility is a top priority for your business, then a business line of credit may be the ideal choice. Unlike a traditional loan, which provides a one-time lump sum, a business line of credit gives you the freedom to access funds when you need them. This flexibility can be a lifesaver for businesses with varying cash flow needs, enabling you to cover unexpected expenses or take advantage of growth opportunities. Interest costs. Business line of credit versus loan. The cost of borrowing is another critical aspect to consider. Business lines of credit typically come with variable interest rates, while loans offer fixed interest rates. If you're concerned about interest rate fluctuations affecting your costs, a business loan might be a safer bet. However, lines of credit can offer lower interest costs when managed wisely. Qualification and application process. When comparing business lines of credit versus loans, one key advantage is the ease of qualification and application. Traditional banks often have stringent requirements for loans, including high credit scores and extensive financial documentation. In contrast, obtaining a business line of credit is typically easier, making it a viable option for newer businesses or those with less than perfect credit. Collateral and security, a loan requirement. Most business loans require collateral, which is a valuable asset you pledge to secure the loan. Collateral provides security for the lender, but can be a risk for borrowers if they're unable to repay the loan. On the other hand, business lines of credit are often unsecured, meaning you don't need to put up collateral.